Hi, everybody. Hi. Hi. Welcome to the Athenaeum and to what I hope will be the first of sort of breaking news Ath talks called Just-in-Time Ath. So if you ever have an idea for Just-in-Time Ath, let me know. So Just-in-Time Aths will leverage the varied expertise of our wonderful faculty to help us understand and navigate current events in real time. Today, with the focus on the ongoing banking crisis and the financial turmoil in the financial markets, is our very own Angela Vossmeyer. Angela is an associate professor of economics at CMC and a faculty research fellow at the National Bureau of Economic Research. Her research interests include econometrics, Markov, chain Monte Carlo. I'm not really sure what that is exactly, but I don't think it's related to the Monte Carlo party at CMC. You'll correct me if I'm wrong. She also works on simulation-based inference, financial economics, financial crises, and economic history. She was recently a visiting scholar at the Board of Governors of the Federal Reserve in the Division of Monetary Affairs. Today, Professor Vossmeyer will help us make sense of the banking turmoil that was precipitated a few weeks ago with the collapse of the Silicon Valley Bank, a turmoil that then spread to other regional banks, American banks, and even to Credit Suisse in, of all places, the banking haven of Switzerland. So detailing the sequence of these events, she will examine the policy responses that followed, draw parallels to previous crises, and evaluate if lessons have been learned or, in fact, if mistakes have reoccurred or been repeated. This is a great opportunity to hear from a premium researcher and a colleague, so please be present, silence, and put away your devices. And as Professor Vossmeyer talks to us, just think about questions you might have for the Q&A session after the presentation. And now, please join me in welcoming Professor Angela Vossmeyer to the Athenaeum.
All right, thank you for that introduction. So the plan for today, talk about bank runs and policy responses. And so as she mentioned, we're going to embark on a preliminary discussion of what's going on today in banking. And the reason I say preliminary is because economists are still wrapping their heads around the Great Depression. So we have 100 years to kind of get this one pinned down. So it's early for us. But exactly, we'll go through a timeline of the events that have happened, but I'll spend a lot of time actually talking about the policy response and comparing it to how we responded to previous crises. So this is the basic timeline of what's happened so far, what kicked things off. On March 8th, Silicon Valley Bank announced a $1.8 billion loss. And what it was doing is it was selling these long-term government bonds to meet immediate deposit withdrawals that it was facing. The problem is that the market value of those was very low because when interest rates went up, there were more attractive products on the market. So it ended up being a fire sale. And anytime there's a fire sale, it just screams emergency. And so, of course, the next day, March 9th, was just a complete bank run. So depositors at that bank largely were uninsured, about 90% of them. And so they all ran to the bank and tried to pull their money out. But banks in the US don't work like that. They don't hold all of the money that's being run on. And so it was just a complete collapse. And so March 10th, the FDIC stepped in and took over as it normally would in this situation. So this is our complete bank failure. Now, luckily for regulators, March 10th was a Friday. So regulators had 2 precious days to figure out what to do. And normally they don't get extra time, and so this was a crucial weekend. And so on March 12th, that's the Sunday of the weekend before world markets open, regulators made 3 big announcements. First, they had taken over Signature Bank as well, so it was like, oh, we got another one. Second was that they started the Bank Term Funding Program, which we'll talk about a little bit, but this is an emergency liquidity facility for other banks that are experiencing problems. And then the biggest announcement, of course, was that they were enacting the FDIC's systemic risk rule, which legally allows them to insure all of the deposits of those banks. So even the folks that were uninsured could recover their funds. And so this was a big one, and we'll talk about that one as well. So that was the initial response, and then the week that followed was just what you would see in terms of contagion. So we saw contagion spread to other regional banks in the US, with First Republic Bank kind of taking a lot of the heat there. JP Morgan and a bunch of the other big banks injected $30 billion of deposits into First Republic Bank. And these were just standard deposits, so they weren't, getting priority in that bank, which was kind of an interesting approach. And then, of course, it spread overseas, and we saw UBS acquire Credit Suisse. So, as usual, bank run, then bank contagion, and then just last week we saw the FDIC finally is kind of completing its auction of Silicon Valley Bank, where it sold the bulk of the assets to First Citizens Bank, but it looks like there's about a $20 billion loss to the insurance fund there, which bankers get to pay back into, right? So a couple things to take away from this timeline is, one, banking crises move very fast. Two, the policy response needs to be just as fast, and it needs a lot of foresight into what's going to happen. And if I were to just paraphrase, what's a good response to a financial crisis, it is restoring confidence in the financial system. Because banks only work if we believe that our money is safe in them. Even the healthiest, most well-capitalized bank in the US, if it experienced a complete run on its deposits, it would not survive. So it is very easy for the panic to go from a bad bank, maybe it has bad management, to a good bank. And then you start getting undue losses and the crisis gets worse. So let's talk about one particular thing. What was special about this crisis? And my answer is not very good. It's nothing. This was your standard run-of-the-mill, old-fashioned deposit run. The news likes to place a lot of emphasis on social media and call this a Twitter run and all these things, but it's not necessary. Banking panics have always moved this quickly, with or without the internet. And actually, my favorite bank run, or at least breaks my top 5 bank runs, right? Like, if I were to pick, it's the Bank of the United States. And I know the name sounds fancy, but it was just a commercial bank in New York City. But it's 1930, so picture a fragile time, of course, in banking. And on December 10th, a disgruntled shareholder who got bad customer service just started a rumor that the bank wasn't doing well and that it refused to sell his stock. And a few hours later, this is midday, and that's actually the picture that you see over there, 20,000 people had gathered outside that bank trying to withdraw the money. And so folks that got inside were able to get some funds out, but it was pure mayhem. Like, the cops were there, they were shuffling people around. And of course, December 11th, the bank failed. It was taken over by the superintendent of banking, who would have been the regulator at that time, because this was a state-chartered bank. But as you can see, no Twitter, and it runs just as fast. This is just how they always look. The reason, though, that this breaks my top 5 bank runs is that folks didn't really know the difference between the Bank of the United States, just a commercial bank in New York City, and the Federal Reserve, right? The name is kind of confusing. So when it hit headlines, people thought the Federal Reserve failed, and things went into a complete frenzy, which is funny, but we're seeing the same thing happen today, because First Republic Bank is, under a lot of distress, but sadly, Republic First Bank, who's completely unrelated, is having just a massive slide in their shares because just naming problems, right? So this kind of like mania is what we have to deal with, right? So the good thing, though, about this being, a regular old-fashioned deposit run is that it's very easy to detect where the run is coming from. The run is coming from uninsured depositors. So policymakers can see that, they can react to that. That's not always the case. The global financial crisis of 2008, 2009, the run was very difficult to detect. It was happening in the shadow banking system, so money market mutual funds, repo markets, and so it wasn't immediately apparent to regulators where the run was happening. Here, we can see it, it's right in front of us, so then we can react to it. But kind of poking back to history and things like that, it tells us, I don't know, I think a key thing to take away is that financial crises are always going to happen. As long as short-term debt exists in the market, financial crises will occur, right? We always will feel an incentive to run if we need to. So there's a lot of discussion, at least some policymakers like to bring up this idea of preventing crises altogether. And I think that's pretty nonsensical. I think they're always going to exist. It's almost like a natural phenomenon. And so when we think about policy responses, we should always think about how do we fight the crisis, do it well, not repeat old mistakes, but also develop preventative measures, not to prevent it completely, but to lessen the buffer of spillover effects to Main Street, shrink the magnitude of the crisis, and these sorts of things. So the way the talk, as you can see at the top, we'll talk about fighting mechanisms and then also buffer mechanisms. But I always like to think of like financial crises almost like we study wars, right? As much as we would love to say a future war, like prevent wars altogether, it's just not going to happen. The probability of a future war is non-zero. So when people study military science and these sorts of things, they study, one, prevention efforts, of course, but fighting efforts. And so financial crises kind of need to be treated the same way, realistically. So how do we do that? How do we fight financial crises? I'd say rule number one is to act fast and provide liquidity. And that's exactly what the Federal Reserve did in that precious weekend. Like I said, I think they got very lucky with a Friday failure. But in that weekend, they did two things. They set up that bank term funding program. So this is an emergency liquidity facility available to existing banks. And what they do is they offer 1-year collateralized loans. And the beauty of it, this was a big policy decision, is that the collateral is going to be valued at par. So those long-term government bonds were not going to face that same kind of fire sale discount that Silicon Valley Bank faced when they turned them or tried to sell them. In the first couple of weeks, we saw about $53 billion get taken out of the bank term funding program, which is good in the sense that we, once the facilities are there, we want banks to build up those liquidity buffers. But actually, the real big take-up is happening at the discount window. So the discount window is the Federal Reserve's standing facility. It's always available to banks. But it is kind of the emergency facility, so people kind of view it in that way. And it offers overnight loans, generally for 90 days, but that flexible collateral requirement that they did at the bank term funding program, they also did at the discount window. So in the first week of the crisis, the discount window had $300 billion taken out, which is just huge take-up of the discount window. And it continues to be hundreds of billions every week, which is really interesting to see. And we'll talk about this a little bit more in a second. So far, we acted fast. We provided liquidity. You might wonder, have we always been good at this? And the answer to that is no. We paid very costly lessons for this in the Great Depression. So the Great Depression's emergency facility, like the bank term funding program, was titled the Reconstruction Finance Corporation, and it was not established until 1932. And so the Depression kicked off in 1929. So we're talking, it took years to develop these liquidity facilities, whereas it took a weekend this time, which is pretty amazing. And Federal Reserve district policy was very different back then. It actually varied by the district. So discount window, the rates and interest rates and everything varied at the district level, which sounds wild, right? That means like interest rates, like in our district, the San Francisco district, were different than the Dallas district. But there's nothing an economist loves more than policy differentiation across a border. This is just where they go wild. So there's a nice study out there that compares the 8th district and the 6th district. The 8th district was famous at the time for following strict lending policies. They kind of were of the mindset that banks should fail. If a bank is struggling, it's a bad bank, and so if we let banks fail, we'll be left with like a stronger, healthy set of institutions. The 6th district, the Atlanta district, was the opposite. So they thought lending policies should be very loose. In the Depression, they dropped the discount rate. They got liquidity out to banks. And so what economists did is they studied this border, which nicely splits states. Again, economists love that kind of stuff. And what they found was that, of course, the bank failure rate was much higher in the 8th district. But not just bank failures. Business failures were really high. Unemployment was much higher. I mean, the real economy just suffered, and not for a couple years, it was throughout the decade. It took forever for those regions to be resuscitated, whereas in the 6th district, fewer banks failed, fewer businesses failed, unemployment didn't get to the super high levels of the 8th district, and so that was pretty good evidence that, you know, acting fast, providing liquidity is important, so you don't get those undue consequences to healthier institutions. We tried to act fast in the global financial crisis, but it was a little bit more difficult. One, because, like I said, the run was harder to detect. It was coming from the shadow banking system. But two, our facilities weren't operating like we wanted them to. So the discount window, right now we're seeing, like I said, hundreds of billions of dollars of take-up right now. It was very stigmatized in the global financial crisis. And what I mean by that is banks were very reluctant to go to the facility for help. Discount window loans are supposed to be confidential. The reason for that is because as market participants, if we find out our bank is receiving an emergency loan, we don't want, like, you're inclined to act on that information, right? And we don't want more runs, so you want it to be confidential. Well, people can kind of started to figure out and guess which banks were getting these discount window loans through the Fed's weekly, I think it's called like the H41 release. And there was some leaks that came through. I think it was the Wall Street Journal. And so because of that, banks stopped asking for help. But when that happens, critical liquidity is not entering the financial system, so the facility is not doing its job. Regulators can't do their job. So the Fed did two things to kind of overcome this stigma problem of the facility. One is that they designed the term auction facility, and it's TAF. And as you'll see, there's like acronyms for everything. So at least you'll leave here with all the acronyms. This facility was not stigmatized because it was an auction, and there were many winners to the auction. So many banks were announced as winners, so it didn't look like this one-off loan going to the single bank. It was more participation. And there was a 3-day delay in receiving these funds. So difference between an overnight loan and something that comes 3 days later, apparently to market participants just looked a lot less desperate. So people were okay with their banks receiving funds through TAF. The other thing is the Trouble Asset Relief Program, TARP. Regulators were pretty concerned that it would be stigmatized, so they basically forced all of the big banks to take money. So when it was, you know, when people saw who got money, it would be like, well, it was everyone. What can you do? This was a very juicy conversation between the Treasury Secretary and all the big bankers, because a lot of the big banks didn't want to take the money, and Henry Paulson basically intimidated them and said, if you don't take this money now, I'll never help you again. Or I think he said, your subsequent government intervention is going to be a lot less generous. And so they were all like, okay, I'll take the money. So TARP got funds out, and that's what we did. Okay, so this is the take-up at the discount window going back to 2008. So this is just week 1. So this isn't even updated to today. Today we would have exceeded the global financial crisis in terms of discount window take-up. But just its immediate take-up at the discount window, which is good to see. That's the COVID. But you can see this kind of stutter stepping happening here. This is the delay in that liquidity in the early global financial crisis. It's really not until late 2008 do we start to see the take-up. But again, you're talking about almost a year of liquidity not getting to markets, and right now we've gotten it there in about a week. So this is one realm where I think we're doing a better job than we've done in the past. The next fighting tool, of course, is to calm the panic, which, again, this was a little bit easier because we knew exactly where the panic was coming from. It was coming from uninsured depositors. So to do that, the FDIC enacted its systemic risk rule, which they say legally allows them to, insure even the uninsured deposits. And conveniently, we always get some nice reassurances from presidents. This is all, anytime a crisis happens. So Biden came out very quickly and said, Americans can have confidence that the banking system is safe. Bush, in December 2007, said the basics of the economy are good. Roosevelt said March 33, which was the trough of the Depression, I can assure you it's safer to keep your money in a reopened bank than under your mattress, which was a problem at the time. And so these three are giving a very clear message, right? Stay confident in the financial system. Keep your money in banks. But convenient for all of us, like we love a good comparison, is President Hoover, Hoover was more of this 8th district mindset of like, let the banks fail, they're bad. And so it was actually his Secretary of Treasury, Andrew Mellon, who said this, but he was with him at the time. So he said, liquidate labor, liquidate stocks, liquidate the farmers, liquidate real estate, purge the rottenness out of the system. So can you imagine just like, everyone's already panicking and he's like, run, baby, run. Like, so, and that's what, this was 1930 and things went from bad to even worse by 32, which is when he corrected course, started liquidity facilities, and then, Roosevelt took office thereafter. But it's funny to read, and of course we see this, but it happened every crisis. There's always, politicians that always are like, let them fail, let them go, they're bad, which, to be honest, bad banks need discipline for sure, right? There needs to be disciplinary action, but in the midst of the panic is not the right time to enforce the discipline, right? You need to calm the panic first to prevent the undue failure of good institutions. And then you can take that disciplinary action, right? It's like, somebody who's speeding, who causes a massive car pileup or something, like you should probably render the aid to the vehicles before you're like writing the speeding ticket from the carnage or something, like you gotta render or at least calm the panic. So a newer mechanism that we're seeing is for fighting crises is marrying good banks with bad banks. So this would be the UBS acquisition of Credit Suisse. 2009, we saw JP Morgan Chase acquire Washington Mutual, Bear Stearns, Bank of America taking over Merrill Lynch, and so forth. And all of these are happening with the facilitation and support of the regulators. So they're offering liquidity support, they're offering backstops. And this, again, is meant to calm the panic, right? Everybody was pretty worried about Credit Suisse. UBS stepped in. We're all still a little worried, but now we're kind of waiting to see how this plays out. And I have to give credit to Professor Gelman in the back for sending me this meme with the text message read, banking in 2024. So if you can't read, it's a bank teller, and she says, welcome to UBS, Credit Suisse, SVB, JP Morgan, Chase, Citigroup, Wells Fargo, HSBC, Lloyd, Barclays, Bank of America, Japan, China, Europe. So eventually it's just going to be one mega bank running things. But to be honest, the notion of these shotgun bank weddings, I think in the very short run, it does achieve a little bit of a calming mechanism, but I have a lot of trepidations of its implications for long-term financial stability. And this is actually a newer research topic that my FEI and low RAs are helping me with. I see some here, so. But what we're showing in a lot of this research is that these shotgun bank weddings, like risk doesn't miraculously evaporate from the financial system when you bring institutions together. Risk is just getting redistributed, and the redistribution is happening to now an even larger, more interconnected bank. And so this notion of systemic risk remains, and it just gets worse and worse. And then this plays into, of course, too big to fail, which is something that's been talked about heavily since the 80s, but especially in these recent years where banks are just getting bigger and bigger and bigger. So Dodd-Frank had two big provisions in it to address this. One was called the Orderly Liquidation Authority, which was a process to quickly and efficiently liquidate large and complex institutions. Sounds nice. And the other one was a living will. So all the big banks now have to keep a will, which is the strategy for a rapid and orderly resolution in the event of a failure. And it sounds very nice. Dodd-Frank, I looked this up just for the presentation. Dodd-Frank uses the term orderly 82 times in this section. And I don't care how many times you use the word orderly, like my belief is that this would just be mayhem, right? Can you imagine Bank of America is going down and they're like, wait, we got the will. We have the will. It's gonna be orderly, don't worry. No, and I don't think, this is obviously my personal belief about these policies, but I don't think I'm alone in this feeling because these are not even being talked about right now. So a little bit of window dressing, I think, on Dodd-Frank. It sounds nice, the big banks have a will, so they can fail if we allow them to, but I don't see these happening. But maybe I'll be proven wrong on this front. Now we'll spend a couple slides just talking about some of the buffers that are meant to kind of prevent the severity of crises. One, of course, is deposit insurance. Bank runs have become much less prevalent in the realm of deposit insurance. So in the United States, the FDIC's first cap on deposit insurance was $2,500. That was your max insurance. And as you can see, it's jumped up over the years. So one of the big things that people are talking about is, this needs to be increased. And if you look at the timeline, we're probably due for an increase, but this would not have made a material difference at all with this current banking crisis. So the uninsured deposits at Silicon Valley Bank were in the hundreds of millions of dollars. I think Roku was one of the companies, had about 500 million in uninsured deposits. And I read this story recently, a payroll company, Ripple, was using Silicon Valley Bank to disperse its payroll to thousands of companies across the US. And these weren't big companies. I think they said that the average annual salary of an employee that they were dispersing payroll to was like $55,000. And 80% of the companies were outside of California. So this note, a lot of people say, this is just a tech sector problem. This is just, Silicon Valley. It would have very quickly become a much bigger problem had these deposits not been paid out. That was a little bit of an aside. But anyway, there was hundreds of millions of dollars of uninsured deposits. So deposit insurance definitely is that buffer, but we know it does come with pretty high costs. One of those costs, of course, is moral hazard. Banks know that their depositors are protected, so they're inclined to take on more risk. The second one, which is talked about a lot less, is disciplining mechanisms coming from the depositor themselves. It wasn't too long ago that banks used to advertise their balance sheet in newspapers and magazines, and they would, say things like, this is how much capital we have, and this is how low our risk is. And so depositors or firms that were looking to put their money in a bank would shop. You would look around and you would find a bank that was well capitalized. We don't really do that anymore. Depositors don't really discipline banks, right? Wells Fargo went through quite a bit of drama with making fake depository accounts, things like that, and people didn't really move their money. Where you put your bank in your institution could be, where your parents put your first birthday money, and that's where you kept it. It's a very sticky decision now of where you put your deposits. And so because we don't shop our deposits around anymore, banks don't face penalties from depositors for making bad decisions. So these are kind of things that, definitely need to monitor. At least we need to recognize the cost that we're paying for deposit insurance. The other one, of course, is as a prevention mechanism is this supervision and stress testing and examination on banks. So of course, the big one we're talking about today is stress tests, because a regulation in 2018 made it so Silicon Valley Bank was no longer subject to the harshest stress tests that were being given. And so the big question that people like to pose is like, oh, had we been able to stress test them, maybe we could have avoided this whole thing altogether. And the simple answer is it wouldn't have mattered. So the 2022 stress tests, these are basically like catastrophic scenarios that they impose on bank balance sheets. And so they imposed unemployment at 10%, declines in real estate of 40%, a GDP decline of 8%. The embarrassing part, or maybe the funny part, is because these are all so catastrophic, it would be obvious that the Federal Reserve would drop the interest rate to 0. And so that was the assumption in all of the models. And so of course Silicon Valley Bank would have passed the test because their problem happened when the interest rate was non-zero, right? It was up and high. So maybe if you wanted to be very forgiving, you'd say, well, this crisis is just looking a little different. But actually, it looks a lot like the saving and loan crisis in the 1980s. Saving and loan institutions had the business model where you just lend long, borrow short. And so, of course, this maturity mismatch, this problem that happens when interest rates rise, gave rise to the savings and loan crisis. So we just needed to look a little bit further back in history to perhaps build this into some stress testing models, or at least things like that. So if I'm like grading, policy response, this is definitely the biggest realm that needs work. And stress tests are newer in the sense that they came about in the global financial crisis, but we've been putting banks through exams forever, since the existence of banks. And probably the biggest bank exam in March of 33, we did about 16,000 bank exams in the matter of a couple weeks. And again, my FEI RAs can tell you how well machine learning algorithms predict the outcome of these exams, or how not so well they work. It depends on which side you want to ask. But this is certainly a realm that needs lots of improvement. And then lastly, on the prevention front, something that I think we are doing a better job at so far is regulatory coordination. So it wasn't too long ago, just before the global financial crisis, was financial institutions, they're very smart. They used to game the regulatory system. And so for the most part, institutions want to, if they can, avoid getting the Federal Reserve as their regulator because they're the strictest. And so not too long ago, firms like AIG and IndyMac had structured part of their institution so that their regulator was the Office of Thrift Supervision. That was notoriously the easy regulator at the time, and if you don't recognize the name, it's because we got rid of them because they did such a good job. So this was a problem back in the day, and then when crises did unfold, so when AIG did become problematic and it was on finally the Federal Reserve's radar, they were like in the dark. They were surprised that this was happening, but of course financial markets are so interconnected that the regulators now need to be very interconnected, and I would say that is what's happening. So Dodd-Frank established FSOC, which is the Financial Stability Oversight Council, and it's the combination of the Treasury, the Federal Reserve, the FDIC, the Comptroller of the Currency, Consumer Financial Protection Bureau, the SEC, and even more. They all come into one, and it's for the purpose of financial stability and market discipline. And so this is something we're definitely seeing. I think the message coming from regulators at this point is, for the most part, very uniform. They're being pretty clear, although the thing that they're not being very clear about is what they're going to do if more banks fail in terms of uninsured deposits. That's one thing that Janet Yellen waffled on a little bit, and I think it makes everyone a little nervous. But otherwise, they are presenting a fairly unified front on this. So I think we're getting pretty close time-wise, so I'm going to kind of summarize, and I guess this is a final report card. I should have used grades, like actual letter grades. Maybe that'd be better. But in terms of old problems, acting slow, we didn't repeat that. Tight liquidity, we did not repeat that. Panic depositors, so far so good. But again, I think the messaging there is still leaving room for uncertainty. Removing stigma from the facilities, so far so good. Banks seem very willing to take liquidity. Poor coordination of regulators, so far so good. Supervision needs major improvement, unsatisfactory maybe is what I should have said. And then systemic risk, this seems like something that we're going to punt for another day. Oh, I guess this is the, it just automatically shuts you off when you're, well, that was actually the end. But yeah, systemic risk, we're not quite addressing that. We're going to address it at another time. But yes, I'm happy to take questions, unless it's like the Academy Awards, we're not going to get shuffled out.
Thank you so much for joining us. Please, a big round of applause for Angela for putting this together. We now have some time for questions and answers. So if you have a question, just put your hand up and either Brian or I will come to you with a mic. And please just introduce yourself, stand up, introduce yourself, and we'll take it from there. Thank you.
Oh, no.
Okay, I have several. No. So one of the things you mentioned was that of late they've been resolving these by finding buyers. And that seems to have gone off the rails in this case. And that's just struck me as odd. You would think, that Silicon Valley's banker would have been an attractive prospect. One option is there's some stuff on that balance sheet that's pretty scary. Option two that you kind of hear in the press is that the Biden administration was weirdly worried about, market power. And so I'm just curious if you have any thoughts on that one.
I think it's, my guess at this point is the former, in the sense that I think there's worse stuff on that balance sheet than we know about at this point. And they seem pretty quick to open SEC and DOJ cases against them. So that's my guess, because, yeah, it sounds like they shopped very hard over that weekend, and they only received 2 offers, from what I understand, and I guess they would have been far more costly to the FDIC. So they did the cheapest option, which was to liquidate and then break it up and sell it. But they've been pretty clear that sounds like they tried, and it wasn't looking good.
Yeah. So as an entrepreneur, I had all my money in SVB when it went down. We were very lucky to get out of that. The last thing I want to be thinking about is where we put our capital. And I understand moral hazard, but what's the reason not to just insure all deposits? Because now everyone else like me is just opening many bank accounts. So effectively the FDIC is insuring all of it anyway. It's
Right.
just a lot more logistics, and I don't know if it has a negative impact on competition with banks.
Yeah, that's actually, it's a good question. I would say perhaps it would be the unequal costs of doing that on the depositors. So if, let's say we do make a blanket decision, insure all deposits, right? So that means that banks are now going to pay much higher fees for that insurance, and those fees eventually get passed on to depositors, which for households, who were already under the 250 or whatever they're going to raise it to, we'll end up paying those fees somewhere, whether it comes through less attractive loan products, overdraft fees, things like that. Whereas, the ones that reap those benefits would be the larger companies. But I do think there needs, because, yeah, all corporations are going to be well above the limits, and it's silly to, like, right now you can pay for services that says, like, it'll insure you into the millions, but they're doing exactly what you're saying, is that the service just divides up your money into many banks and stuff. So I think there needs to perhaps be a product offering or something that's available to corporations. But I don't think the policy response is going to be a blanket all insurance. But they definitely need to think about what to do, because the trouble now is that they've made this decision for these 2 banks. And is it fair? Can you actually make a different decision for other banks if this crisis continues and we see other banks fail or something like that, right? Where do you draw the line and say, so eventually are you just going to say, okay, we'll do it for this crisis, but after that, I don't know, you know. So there definitely needs to be, I don't know, a product or a mechanism for that. My thinking is why it wouldn't be a blanket offering is because of that disparity between the household depositor and a corporation depositor.
Hi, Professor Vossmeyer. I have two questions that are related. Firstly, why is it that there's so many more banks in the US, like small banks compared to other countries? Like, it's just saturated with a lot of small banks. And then my second question is, do you think that the financial system in the US would be healthier if banks were more consolidated and just larger and fewer banks?
Oh, good question. Why do we have more small banks? I think that would probably go back into the history of banking policy in the U.S. We didn't allow full branching for a long time. So this is actually very few banks right now compared to the history of the U.S. Like 1929, it was about 25,000 banks, and they were all unit banks, and they weren't allowed to branch unless you were in California and certain regional areas. And so once we allowed branching, I think this concept of community or unit banking just is kind of like ingrained in the history here. So people like to see that. People like the community feel. That's why we have a lot of credit unions as well, where we can group customers by a common depositor base. And then would we be stronger if we had, well, if we had few big banks? I mean, at what point do you become so strong that they're just national banks, right? Where it's just, you know, the Fed will never let them fail. The Fed mostly controls them, and like, do you get independent product offerings and things like that? So I think a beauty is the diversification in the banking system here. And our entrepreneur friend can tell us, actually, the Silicon Valley Bank was a very attractive place because I believe of how they were able to move funds, and like, they attracted tech companies for those reasons, so they could deploy funds to many areas and things like that, and efficiently. So I think we would lose a lot if we just had a couple of big banks. But would it be safer? Probably, because we wouldn't let anything happen to them.
Professor, I was just wondering if you could speak a little bit more about the bank wills, and I'm just sort of curious if those are sort of public and private and how regulated those are as well.
Oh, good question. And I don't have a good answer for that because I just read, you know, like what I know of it is what's written in Dodd-Frank, and I believe that they, of course, when they write them with regulators, right? They have to be approved and everything. I believe parts of them are public, but I don't have a ton of information on that. I was mostly just critical when I read about it once, and I guess I stopped there.
Professor Vossmeyer, my question pertains to, so during these fire sales and crises, we see kind of the acquisition or taking over of banks and kind of the consolidation of the financial system. Is the reverse true according to like regulatory law, that the regulatory authorities have the right to go and break up banks and create smaller institutions out of them? And what could the possible repercussions be in the case that the authorities took such action?
Oh, like make them smaller. Do that? Oh, that's a good question. I mean, when they step in, like with Silicon Valley Bank, they're breaking it up in the sense that some banks are buying a bulk of the loans and some banks are, but have they ever stepped into a bank? I guess that would go back to when we were used to separate, you know, commercial banking and investment banking and things like that. So legally that might get into some differences there, but yeah, I'm actually not sure, like the limits of that legal authority. Maybe.
Yeah, I don't think so.
Yeah.
I mean, I think you have to do that through the Federal Trade Commission or, you know, somebody can just the acquisition.
Mm-hmm.
So, because yeah, you're right. The only thing I can think of is actually breaking up investment and commercial.
Yeah. Mm-hmm.
Separating investing in commercial banks?
Oh, I think everything's always on the table in the banking system. Yeah, I mean, the banking regulation changes, and when it does, it changes dramatically. Like I said, like branch banking used to be illegal in most states where, you know, every single bank was an independent unit authority. And so obviously when we change that, now everything's a branch bank. So I think everything's on the table.
As a European who has worked in a bank in Estonia, for example, one of the biggest costs is kind of the cost of compliance, and with completely keeping up with the regulatory changes that happen, you know, instantaneously. It seems like every week there's something that needs to be complied with. Is the same level of regulatory change constantly happening in the United States? And where do you see the discrepancies between, for example, the European Union's banking laws and the United States, and whether one or the other provides more safeguards than the other?
Ooh, good question. So at least here, to be honest, I can speak more confidently about what goes on here. So yeah, every time we impose these new regulations, it's very costly. Big banks can pay the costs and like do the legal research. Oh, it came back. There we go. But that was actually how Silicon Valley Bank became disclassified as a systemic institution in 2018, because it was all the community and smaller banks that basically fought against these big regulations, because they're like, it's very costly for us to pay, you know, to change our institution to meet these new regulations. So usually community banking acts give lighter regulations to these smaller regional banks. Relative to European banking, it's being in a currency union, I think, makes everything harder, I have to imagine. Where here we combine like fiscal and monetary policy a lot more. They don't have those luxuries, so I think that's like another layer of complexity that they need to navigate.
It sounds like from what you're saying, the collapse of Silicon Valley Bank wasn't because of, you know, criminal activity or, you know, gross negligence, but I think there was definitely a bit of that at Credit Suisse. Do you think the system would benefit from more punitive action against bankers, especially, you know, during the financial crisis? There was a huge amount of, you know, fraud and criminal activity, and a lot of the bankers kind of got away with it. So do you think that that's something that the system would benefit from?
Yeah, yes. So bankers need to be disciplined. And actually, I wouldn't say that Silicon Valley Bank there was a lot of, I think it was a lot of bad things, negligent mismanagement. I mean, it actually, oh yeah, this was the slide that we didn't get to, but yeah, so this was flagged on Silicon Valley Bank's balance sheet early on in 2021. The San Francisco Fed flagged problems, and they received citations for these problems, but it was all bark, no bite, right? And so one of my complaints, certainly, the Federal Reserve needs to have some sort of mild disciplinary actions, and I don't have good ideas for what that should be, but not letting them sell off their stock seems like a good starting point, right? Selling off their stock before the collapse happens is like terrible, which is why criminal investigations are happening, at least from the SEC and things. So, yeah, but I think discipline needs to be there, or else risk-taking will continue. I hope so, but you know, I say I hope so, but Ben Bernanke said after the 2009 crisis in his book, he was very unhappy with the subsequent discipline that happened, and he was like, there was many people that should be in jail that are not. They're just living on their cash, you know, their golden parachutes, if you will. So I hope we see actually something more now than we saw before, because I think we need to send a signal.
And with that, thank you so much for joining us. Thank you, Angela, for that great presentation.